in these credit default swaps and other derivatives to explode. We collectively bought into this fantastical notion that the market would protect the system against risks, and at the urging of Greenspan, Summers, and Rubin, we essentially allowed the ratio of fire risk to available fire hoses to get wildly lopsided toward risk. And then we scrapped the fire department and the fire code, and we let Wall Street build a bonfire big enough to burn down the neighborhood. Well, let me bring you back from abstract land. Freed from regulatory oversight, the notional value of credit default swaps, that is to say the value of the investments that these credit default swaps supposedly insured, expanded from about $1.6 trillion in the middle of 2002 to $45 trillion by the middle of 2007. And by 2008, the notional value of all financial derivatives had reached 10 times the worth of the world's annual economic output. I mean, that's a level of absurdity that just simply beggars any conception of managing risk, only in Neverland. Down here on Earth, when housing prices fell and financial institutions suffered losses, they soon discovered that alarmingly few dollars had been set aside to cover their supposed insurance claims. And then lovely, wonderful thoughts got very, very hard to sustain. Millions of people lost homes and jobs. Trillions of dollars of paper wealth was destroyed, along with dreams of college, retirement, or simply keeping gas in the car to go to a job interview for a job you probably weren't going to get anyway. But the really upsetting part is that even after the frightening events that we've lived through, the collapse of large investment banks, most prominently Lehman Brothers, $700 billion taxpayer-financed bailout, unemployment previously above double digits and still close to it, and a still accelerating wave of homes lost to foreclosure, we still have not altered the basic incentives that got us to this mess. And by the reckoning of most experts that I take seriously, we have to have rules that force financial institutions to significantly increase the capital that they reserve against their trading positions. They have to put more dollars aside to cover their losses. Derivatives have to be forced to trade on exchanges, like the same sorts of exchanges that stocks trade on, where everybody can see what's happening in real time, can understand the pricing, and where chiefly there is a regulator who ensures that real dollars are reserved against derivatives in the event that bad bets have to be covered. Well, the Obama administration has embraced such rules in general terms, and now, again, that the healthcare bill is passed, we're likely to see some more attention here. But the current proposals that are working their way through Congress really would not constrain the volumes of derivatives. There are all sorts of loopholes that would allow derivatives to continue to trade largely unregulated, unscrutinized, and they leave us exposed to a mass chain of defaults. And in fact, some argue, and I think with real merit, that in the wake of the bailouts, we're actually more vulnerable to a crisis than we were before because we haven't changed the rules, we haven't gotten the requirements that real capital is reserved, but we have gotten clear, unmistakable proof that if you are big enough as a financial institution that your collapse threatens the broader economy, you will be bailed out. That's what just happened. And that's the only part that's changed previously, is we now, compared to the situation before the crisis, that we now have verifiable proof that even libertarian ideologues will say we have to bail out large financial institutions when push comes to shove. And even the modest proposals that are being debated in Washington have been substantially watered down by very intense lobbying from the financial services industry, which strangely appears to be winning the day with the same sorts of arguments that have successfully killed sensible financial regulation for more than a decade. And that argument is too many rules will stifle financial innovation, it's a global economy, the American core strength is our financial services innovation. If we impose too many rules on Wall Street, the money will go charging to other places, to Hong Kong, to London, to Singapore, and we'll lose jobs and capital in this country. Well, these were the same arguments that Summers and Greenspan in particular employed in the late 1990s as they persuaded Congress to kill off rules that were proposed by a group called the Commodity Futures and Trading Commission that might have forced AIG and other vendors of credit default swaps and other derivatives to set aside real dollars in reserve. That would have limited the amount of borrowed money cycling through the financial system, and it would have moderated the consequences of a shock. Many argue, again, I think with some merit, that the Obama administration committed a real tactical error in not conditioning the second half of the bailout that President Bush began on the acceptance by the financial industry of a really, truly, fundamentally new financial regulatory regime. And the sense I got in reporting this at the time was that Geithner, in particular, the Treasury Secretary, had the upper hand with Summers. The feeling was, you know, the building is on fire now. We can't monkey around with new rules. We've got to just, you know, put the fire out instead of messing around with the foundation, and we'll get to the foundation later. But the problem is that now a sense of complacency is taking hold. I mean, a year ago, when the Obama administration handed over the second half of the bailout, there were serious economists who were saying we could see a repeat of the Great Depression. I mean, we could truly see a system-wide financial meltdown. And there was so much fear, not only on Main Street, but on Wall Street, that the people running the large financial institutions might very well have felt like, you know, we're in no position to argue. We need this money right now. And they might have accepted new rules. Whereas now that moment has passed, and there's a sense that the economy's growing again, financial stocks have performed well. Why monkey around with a good thing? Well, I also think, though, that we have to give some serious consideration to the fact that the disappointing pace of reforms may speak less to tactics and you know, what we could consider a tactical error, and more to the people who actually have their hands on the levers of power in this administration and their basic belief that financial services remains the key area of American economic strength. Summers is back in the White House, and he seems to retain faith that financial services should be at the center of the American economy. He seems to believe that manufacturing, which is the area of the economy where job losses have been biggest and most painful, is old-fashioned, it's dirty, it's not innovative, that's the past, the future is still financial services, and he's particularly inclined not to take on the financial industry for that reason. Summers' longtime protege is Tim Geithner, the Treasury Secretary, who is fresh from overseeing the New York Fed, where he joined with the last Treasury Secretary, the former CEO of Goldman Sachs, Hank Paulson, in crafting the bailouts for major financial institutions. When Summers was running Treasury, and when he killed off those rules at that point proposed by the Commodity Futures and Trading Commission that would have regulated derivatives, he was aided by a key deputy, a guy named Gary Gensler. Gensler's job today, he is the chairman of the Commodity Futures and Trading Commission. He's the guy who's now charged with coming up with the next generation of rules. Well, what seems clear in surveying the statements and policies delivered by President Obama's key economic advisors is that they retain this faith in the market as it was operating prior to the crisis. And this faith, it can be argued, runs counter to the sort of fundamental economic refashioning that was at the center of many of the hopes for the Obama presidency as a truly transformative event. I mean, now, you know, let's pause and note that the Obama